There are a number of financial institutions which are providing financial service, and the service which is provided from one institution will be totally different from that of another institution. The asset will be transferred to the user of the asset for a certain period of time, for which the Y has to pay certain amount which is called as lease rent. After making payment to financial institution, so all the amount is recovered, then the rest amount will be paid to the lessor. Hello everyone, I am Arshita, lecturer, Department of Commerce, Vidhyaashram First Grade College, the Temple of Excellence, Mysuru. My dear students, today we are in the revision 2 of Financial Management 3. Under that you are going to learn about financial services, and this is for 6th Sem B.B.A students. So today we shall revise from Unit 3 to Unit 5. So your Unit 3 is all about mutual fund, Unit 4 lease financing, and Unit 5 is factoring. Let us see what are the topics which comes under these units. Now we shall see what are the characteristics of financial service. So you know about financial service, right? The services which is provided by the financial organizations are called as financial service. Now let us see what are the characteristics of financial service here. So the first one is it is intangible in nature. So when you take a product, so we can touch the product, right? Whereas this financial service can only be felt. So we can't touch the services. So here the quality of services depends upon the quality of information which is provided to the customers. So it is called as intangible in nature. So we just can feel the quality of that service. Next is inseparability. So here the service, the provider of service is not separable in nature. Simultaneously, the service will be produced as well as it will be supplied to the customer. So it is simultaneous in nature, where the provider as well as the service cannot be separated. So it is inseparable in nature. Next, perishability. So for example, if a product, so the product can be stored for a longer period of time. Whereas service, since I have told you, it cannot be touched, we can only feel the service. So it is perishability. So here the service cannot be stored for a longer period of time like a product. Next is variability. So here there are a number of financial institutions which are providing financial service, and the service which is provided from one institution will be totally different from that of another institution. So here there is variability in the service provided as well as the type of organization who are providing the service. Next, dominance of human element. Of course, here whereas if you compare a product, the machinery is given more importance because the machinery is going to produce that product. But when compared to financial service, so here the human will work in order to get a quality service. So here the more importance is given to the human resource, where the humans will provide the service, and the quality of service, as I have already told you, it depends upon the quality of information which is being provided. Now who will create that information? Of course the human resource. So the more importance is given to the human element. Next, information based. Of course, it is totally based on information. So here, as I have already told you, the quality of information is always depends upon the quality of information which is provided to the customers. Now let us see what are the types of lease. So under lease financing, you are going to learn about types of lease. So here we are having 5 types of lease. So the first one is financial lease, second one is operating lease, third one is sale and lease back, fourth one is leverage lease, and the fifth one is direct leasing. So this is a important questions you might get. What are the types of lease? Financial lease, operating lease, sale and lease back, leverage leasing, as well as direct leasing. Now we shall see one by one what is this financial lease. So financial lease is a long term as well as non-cancelable lease. Now what do you mean by lease? So here, for example, there are two parties, X and Y. Now X is the owner of the asset. Now, X will provide the asset to Y for a certain period of time. For example, 10 years. So, Now, Y is going to use that asset for 10 years. For using that asset, Y has to pay what? Lease rental. So here, lease rental has to be paid by Y. Now, the ownership remains in the hands of X itself. The asset will be transferred to the user of the asset for a certain period of time, for which the Y has to pay certain amount, which is called as lease rent. So after 10 years, Y will return back that assets to X, that is the owner of the asset. So this is about leasing. Okay. So under financial lease, it is a long-term lease. So here the duration will be very long. So it may be 10 years, or it may be 20 years, or 25 years. So it is long-term lease, as well as it is non-cancelable lease contract. So for example, if Y don't want that asset for 10 years, but he has made the agreement, he want that asset for only 7 years. In such cases, in the normal lease, they can cancel that lease contract by paying some penalty. But in case of this financial lease, it is non-cancelable. So before the duration of that agreement, they cannot cancel that lease agreement, are known as financial lease. The essential point of financial lease agreement is that there is a condition where the lessor agrees to transfer the title of the asset once the lease period is over. For example, here think that it is a financial lease where X have transferred the assets to Y for 10 years. Once the lease contract of 10 years is over, then X what he'll do? He will transfer the ownership also. But in case of normal lease, the ownership will remain in the hands of owner itself. That is, here under financial lease, after the completion of that lease agreement, here the ownership itself will be transferred. At least it must give an option to the lessee to purchase the asset at the expiry of the lease agreement. The lessor is having a chance to transfer the asset. Under the lease, the lessor recovers 90%. Now, how the amount will be recovered? Through the lease rental itself, 90% will be recovered, whereas 10% will be recovered after the lease agreement. The lease agreement is irrevocable, in the sense it cannot be cancelled. Practically all the risk. Now, in normal lease, all the expenses of the asset will be borne by the lessor itself. But in case of financial lease, here the expenses, everything will be borne by lessee, because at the end he is going to become the owner of the asset. Next is only the title deed. So only the title deed will remain in the hands of lessor, that is the owner. Rest everything will be in the hands of lessee itself. He will use the asset, or whatever the expenses incurred will be borne by the lessee itself. Next we shall go through the operational lease. So an operating lease stands in contrast to financial lease. So it is opposite of financial lease. Now this lease agreement gives the lessee only the limited right to use the asset, whereas in this financial lease, it was for a longer period of time where the lessee can use the asset as ever he want. Only the title will be in the hands of lessor. Once the duration of lease agreement is over, of course the title will also be transferred. Whereas here under operational lease, it will be for a shorter period of time, for example 2 years or 3 years or 4 years, like that. Only for a shorter period of time where the ownership will be in the hands of lessor itself, and after the completion of the lease agreement, the asset has to be returned back. Whereas in financial lease, after the completion of the lease agreement, lessee will become the owner, right? Whereas here, he has to return the asset back to the lessor itself. Now, here and one more, the expenses will be borne by whom? By the owner of the asset itself, that is the lessor. So this is the main difference between financial lease as well as operating lease. Next, sale and lease back. Now, before going through this explanation, I will give an example here. For example, A is the owner of the asset and B is one more party. Now, A is the owner of the asset. Okay. Now, A will sell the asset to B. Now, what A will do? A will take that asset back in terms of lease. Now, the actual owner is A. A will transfer A will completely sell the assets to B, and what A will do? A will take advantage of that asset in the lease agreement. That is called as what? Sale and lease back. Now, A is using that asset in the form of lease agreement. That is known as sale and lease back. Next is leveraged lease. So, under leveraged leasing arrangement, a third party is involved between the lessor as well as the lessee. Now, here a third party is being involved in terms of lessor as well as lessee. For example, what the lessor will do, that is the owner of the asset, he will borrow some amount and he will purchase the asset. So, he will borrow some amount and he will purchase the asset. Now, he is the owner of the asset. Now, he has to return that amount back for the financial institution. So, what he will do? He will give that asset to the lessee in lease contract. Now, the lessee has to make payment to the lessor, right? That is the lease rental. Instead of making payment to lessor, what the lessee will do? Lessee will directly transfer that amount to the financial institution. Clear? So, this is about leveraged lease, where a third party is involved who is financial institution. Clear? Now, the lessee will not make payment to the lessor. Lessee will directly make payment to the financial institution. Okay? After making payment to financial institution, so all the amount is recovered, then the rest amount will be paid to the lessor. So, this is leveraged leasing. Next is direct leasing. So, here direct leasing, as a word itself tells that here the leasing is directly with the manufacturer. That is manufacturer of the asset. So, here the lease contract is between the lessee as well as the manufacturer who act as a lessor. Hope you are clear with the types of leasing. Now, we shall see what is the difference between financial lease and operating lease. So, if you see the first difference, so here financial lease for a long-term arrangement, whereas this operating lease is for a short-term arrangement. Hope you are clear with this. Next is financial lease, all expenses is borne by whom? By the, or in the financial lease, all expenses is borne by the lessee itself. Whereas in operating lease, all the expenses is borne by the lessor. Next, the lease term under the financial lease covers the entire economic life. For example, the whole life of an asset is 10 years, then whole 10 years, this asset will be in lease. Whereas in operating lease, so they will not give for the whole 10 years. For example, the life of the asset is 20 years, then the whole asset will not be given for 20 years, it will be divided. So, it may be 5 years or one more 5 years or 10 years, like that they will divide. So, that is about operating lease. In financial lease, whole life of the asset, that asset will be in the lease agreement itself, whereas in this operating lease, so it will be divided. Under financial lease, the lessee cannot terminate. Of course, in financial lease, the lessee cannot terminate the contract, whereas in operating lease, they can terminate the contract by paying the penalty. Next, while the rent which is paid by the lessee under the financial lease is enough to fully amortize the asset, the whole cash price of the asset will be in the form of lease rental itself under financial lease, whereas the full amount cannot be recovered in operating lease. So, these are the certain difference between financial lease and operating lease. Now, we shall go through a problem on lease financing. So, X Limited is in the business of manufacturing steel utensils. The firm is planning to add a new product line. Now, a business is there which is undertaking or manufacturing steel utensils. Now, they wanted to expand the business. The firm can either require machinery or to get on lease. So, they can buy the machinery or they can go for lease. And this is a problem where the option is given between buying as well as leasing. So, they will give all the information. So, we have to calculate what is the total amount if they go for leasing and what is the total amount if they go for buying the machinery. The machine can be purchased for rupees 3,45,000. Now, this is the cash price of the machine they have given, having a life of 5 years. So, what is the total life of the asset? 5 years. Salvage value is 45,000. That is, after the life of the asset, if it is sold, what the amount they will get? So, that is called as what? Salvage value. The purchase can be financed by 14% loan. So, they can borrow loan. And a buying option, so what they are going to do? They are borrowing loan at 14%. Next, repayable in equal annual installment inclusive of interest becoming due at the end of each year. So this is one option where they are going to buy the asset and the total cash price of the asset is 3,45,000, where in order to purchase that asset they have to borrow loan at 14% per annum, and that amount has to be paid in the form of installments. Other option is that the machinery can be taken 1 year lease. So they can go for lease financing where the lease rent per year will be 1,20,000 for 5 years. Depreciation to be calculated at straight line method, tax at 50%. Suppose if they go for buying option, they have to pay the lease rental of 1,20,000 for 5 years and they have to calculate depreciation also under straight line method and tax is 50%. Now advise the company regarding the option it should go for. So they have given the PV factor at 7%, that is for 5 years, all the 5 years. In the same way PV factor at 14% for all the 5 years. Now we have to think whether we have to buy or we should go on lease. Now for that we have to calculate what are the total cost which is incurred if we go for buying option and what is the total cost incurred if we go for leasing option. Now first we shall calculate the depreciation. Since we are going to calculate under straight line method, your formula is depreciation is equal to cost minus scrap divided by life of the machinery. Now what is the cost of machinery? 3,45,000. What is the scrap? 45,000. So divided by 5. So I'll get 60,000 every year. That is depreciation under straight line method. Next, calculate the PV factor. So PV factor at 14%. PV factor at 14% we have to calculate. Add all the PV factor of 14%. So when you add, you will get 3.432. That is the total PV factor. Calculate the annual installment. That is cost divided by PV factor. So cost is 3,45,000. Divide by PV factor, you will get the annual installment is 1,525,000. So first calculate the depreciation. Next calculate the annual installment. Now go through the calculation of cash outflow. So here you have column year, loan amount outstanding, interest at 14%, principal as well as installment. Now we know the year 1, 2, 3, 4, 5. 5 years. Loan amount outstanding. Now what is the cash price of the asset? 3,45,000. That is given in the question. Now we know the installment. We had already calculated 1,525,000. Now calculate the interest. So how to calculate the interest? That is 3,45,000 into 14%. Clear? That is loan amount outstanding into 14%. So I'll get 48,300. Now how to calculate the principal? We know the installment. So installment minus interest. So installment minus interest will get the principal amount. That is 52,225. In the same way for second year. Now second year, come to the second year. What is the loan amount outstanding? 3,45,000 minus principal amount. So here loan amount outstanding, how do we get? Loan amount outstanding in the previous year minus principal amount, you'll get loan amount outstanding of the current year. Now same way calculate the interest, that is loan amount outstanding 2,92,775 into 14%, you'll get 40,989. Now we know the installment. So installment remains same for all the years. Installment minus interest will get the principal amount. In the same way for third year also, loan amount outstanding in the second year minus principal will get loan amount outstanding in the third year. Next calculate interest. Loan amount outstanding into 14% will get 32,653. Now installment minus interest will get the principal amount, that is 67,872. In the same way for fourth year and for fifth year, be careful here, that is loan amount outstanding is 87,993. Now your loan amount outstanding at the last year will be same as your principal amount. Write the principal amount first. We know the installment we had already written 1,525,000. The principal amount will be same as your loan amount outstanding. Now what you will do? Installment minus principal, you will get the interest. So here you have to be bit careful. Once again I'll repeat, installment minus principal, you'll get the interest amount. So this is about calculation of cash outflow. Next, calculation of present value after tax under lease option. So here you'll be having here lease rental, tax, net cash outflow, PV factor, and you'll get the net cash outflow. So this is cash outflow. Next you'll get the net cash outflow. So you know the year 1, 2, 3, 4, 5. So what is a lease rental? So lease rental is 1,20,000, right? Now we have already calculated cash outflow. Now we shall calculate calculation of cash outflow after tax. So your year remains same, 1, 2, 3, 4 and 5. Depreciation. So we had already calculated the depreciation. So 60,000 each for all the years. Next, interest. We have calculated the interest also in the previous table. So same interest you have to put here also. Next, total. Add these two. You will get the total of all the years. Next, tax. Tax at 50%. So 50% of total. That is 1,08,300 into 50%. You will get 54,150. In the same way, for all 5 years, you have to calculate 50% on total amount. Now, cash outflow. So, we know the installment 1,05,025 minus this tax amount, you will get the cash outflow amount. Now, you know the PV factor of 7% PV factor, they have given in the question, put 7% PV factor. So, if you see the PV factor here, they have given 7% PV factor. So, put 7% PV factor. So, you'll get the net cash outflow. That is cash flow into 7% PV factor, you'll get the net cash outflow. Now, total all this, you'll get total of net cash outflow, that is 2,22,058. So, this is a calculation of cash outflow after tax. So, I have told you depreciation remains same. We had already calculated. Interest also we have calculated in the previous table. Next, when you add, you will get the total into 50% tax. You will get the 50% tax. Next, installment amount minus tax, you will get cash outflow into 7% PV factor, you will get the net cash outflow. Then total everything, you will get total net cash outflow. Now, we know total net cash outflow is 2,22,058 less 55th year salvage value. So, 45,000 is the salvage, 5th year, 7% of salvage value, PV factor is how much? 0.713. So, when you deduct, you will get cash outflow under buying option, that is 1,89,973. Now come to leasing option. So we have to calculate this cash outflow under leasing option. So here also your table remains here, lease rental, tax, cash outflow, PV factor and net cash outflow. So here remains same 1 to 5 years. Lease rental they have given in the question, 1,20,000 lease rental. Next, tax at 50%. So when you calculate 1,20,000 into 50%, you'll get 60,000 each. Now deduct these two, that is lease rental minus tax, you'll get the cash outflow. Cash outflow into 7% PV factor, you'll get net cash outflow. So you'll calculate for all the years, you'll get total net cash outflow under leasing option. So how much? 2,46,000. So if you compare this 1,89,973 under buying option and 2,46,000 under leasing option. So which one you would recommend? So which one is less? So here buying option is less. So buying option is recommended because it is lesser than leasing option. So this is a problem on lease financing. Now we shall go through the factoring, that is a last unit. Now what do you mean by factoring? So here, if any goods are sold on credit basis, so that amount has to be received back, right? So the person who has sold the goods or the organization who have sold the goods does not directly collect the amount from the purchaser. So he will appoint a third party who is called as factor. Now, what is the duty of an factor? On behalf of the seller, so this factor will collect the amount from the purchaser. So, this process is called as what? Factoring. So here it relieves the seller, he can carry on his business activity. So no need to wait for a longer period of time. Factor will give the amount and the amount will be collected from the factor, and for him they have to make some payment which is called as commission or this salary or rent. Now on behalf of the seller, this factor will collect the amount from the purchaser. For him certain payment has to be made. Now let us see what is this factoring. Like securitization, factoring also is a financial innovation. So it is one of the important financial innovation. Factoring provides a resource to finance the receivables. So it facilitates the collection of receivables. As I told you, on behalf of the seller, here factor is going to collect the amount. The word factor is derived from the Latin word facia. So it means make or do or to get things done. So here why factor is called as get things done? Because on behalf of the seller, he is going to collect the amount from the purchaser. Factoring simply refers to selling the receivables by the firm to a party who is called as factor. The factoring refers to the agreement in which the receivables are sold by the firm to the factor, that is financial intermediary. Now here the seller will sell his receivable to the factor, and factor will collect the amount from the purchaser. So this is one of the important financial service. My dear students, hope you have understood the session. See you all in my next session. Till then, take care. Thank you.